All right, so we've been starting on stocks. So the key with stocks in your answer at the exam, it's not just the exam, but just an understanding stocks is what are stocks. So you have ownership, and your return really is driven by expected earnings growth. And I showed you a chart last class that shows that historically, stocks most of the time give you dividend yield plus earnings growth, except for the last several years where they've gotten really ahead of that. So the question we had last class was, what's a good expectation for earnings growth for stocks going forward? And I said that's going to be tied to the U.S. economy. Earnings for stocks have been about in line with the growth in our economy. So where does the growth in the economy come in? So you got to put all these pieces together. So we talked about productivity, labor, and inflation. There were some articles this week. There's almost always an article in The Economist about productivity, what's going on with productivity. There's another one this last week. Almost was going to show it to you because it's really to point. The countries like India, they're talking about productivity in India and how India is growing faster than almost everybody else, but they're so far behind it's going to take them a while to catch up with Europe and even China. But its productivity is the key. But the key there was, where's the productivity coming from? India's biggest issue is probably energy. If you don't have good, reliable energy, that just destroys your productivity. But there's things they're talking about there where productivity is the key to any nation, to any company. And the key for paper 3, you're going to have to do this in paper 3, is what's a good assumption for productivity. You can see historically productivity in the U.S. has tended to range from like 1.5% to 3%. 3% in the 60s, the end of the war, all those GIs coming back, we got all this technology, machinery, big increase, and then our productivity dropped off dramatically in the 70s and 80s. 90s was pretty good, the internet's coming in, the 2000s pretty good. And then as I mentioned with President Obama, he said one of his biggest concerns is why did productivity drop so much? Not just in the United States, but it was a global issue. Productivity really came down. But historically, productivity has been about 2%. I would think a range of 1 to 3% would make sense. I think 1 is you're just saying, well, the big issue for me we talked about last class, the 2 most unproductive industries in the United States is education and healthcare, and they're also very fast growing. I know you see articles all the time that we're underfunding public education, but it's absolutely not true. We've been dumping a lot of money into public education. It's up like 80% adjusted for inflation. And what do we have to show for it? Test scores are no better. Teacher salaries aren't any higher, so you have to kind of ask where's all this money going? If we're spending all this money in public education, a lot of it's going on new stadiums, new counselors. So it's not going on teachers, it's not improving students. That seems pretty unproductive, right? How would you rate productivity? It's your resources versus student outcomes. We plowed in a lot of new resources that aren't teaching students, but spending a lot of money, and student outcomes aren't very good. Healthcare, the same way. I know the murder of that guy a few weeks ago caused a whole wave. In my life insurance company, in life insurance class, we talked about the horrible incentives in healthcare and why it's so unproductive, because healthcare, if it's successful, it goes out of business. If it makes us healthy, they lose revenue. So their goal is to treat us as much as possible without us getting better. And they're really, really good at that. And they've got like the food industry on their side. So there's some things out there that are terribly unproductive that could be fixed. But who do you think's the biggest donor to Congress right now? What industry? Healthcare. How does healthcare want Congress to do? Do you want to be healthier, living longer, fewer chronic diseases? No. You got the food industry out there addicting us to food with a lot of sugar and corn syrup and making us eat too much and become unhealthy. So there are incentives in our system that make us unproductive that I know Kennedy says he's going to fix that. That's going to be an interesting thing to see how far he can actually go with all of that. But that's the argument people make about low productivity in a country like the United States. That used to mean manufacturing, and we've stripped all the productivity we can out of manufacturing. We're really, really good at that. But now we're 80-something% service. We're not as good at productivity on the service side. Now I'm noticing that I've been to my first McDonald's with a kiosk. I didn't like it. I that it was pretty horrible because the screen made no sense to me. All I wanted was a Coke. So I click on a Coke, and the only button available was add to your order. What button did I want to see? I wanted to see checkout. They didn't have that button. So do you add to your order if you don't want anything else? It made no sense to me. What happens when you look over at the workers? They avoid all eye contact, right? They're not even there. You could talk to them as like they're robots. They don't even talk to you. So I think you could fix that pretty easily by just adding a button that says check out now. That would be a pretty smart thing to do, but they don't have that. So it's frustrating. Does that make McDonald's more productive or less productive? I don't know. I remember Continental Airlines, that doesn't exist anymore. It's got merged with United, but they were the first to have kiosks at the airport. Thought, wow, this is great productivity, but then I noticed they have just as many workers with the kiosk. Now they're just showing people how to use the kiosk before they were checking people in. I'm not sure how many people that got rid of, but the self-checkout, there's it's different things people are trying. All of those to me are interesting from a productivity standpoint. There have been studies, there's people worried that if we get more productive, people are going to lose jobs, but there have been studies that the most productive companies hire the most people. The least productive companies go out of business. So what they discovered is really productive companies, they hire more valued workers to do more valued work because of the money they're saving on the kind of the frontline workers. So there is some sense that the firms that are really productive actually add quite a few jobs, but that's the kind of debate you're getting into. And there was a guy running for president. I can't remember his name. He was the big universal income guy. I can't remember his name, but
Andrew Yang.
What's
Andrew Yang.
Yeah, Yang. So he was big on productivity. I don't remember him, that we're going to lose all these jobs because of AI and robotics. That was his big thing. I think even Bill Gates has come out and spoken about that. Everybody's scared to death of AI, but they were also scared to death when they started publishing books that was going to put all these scribes out of business. When they did the car, what all these blacksmiths going to do. There's TV, what's that going to do? The theaters and movie theaters, all this can put them out of business. We have these kind of disaster scenarios, but maybe this time it's different. In the past, productivity has made the worker more productive. The thought was AI is that AI replaces the worker. But are y'all using AI every day? I do it to make memes, but that's pretty productive, right? I used to, when I want to do something goofy on Facebook on text, I had to go out and find an image, but now I just tell ChatGPT, give me an image of a cow riding a bike, and it does a really good job of doing it, a lot better than I can find on the internet. It's pretty amazing. But I also use it for value chain management, Porter's 5 forces, and it does a better job than a lot of resources the library gives us. It's pretty amazing. Is it making me more productive, or is it just another source of research? That's kind of what we got to figure out here. Have any of y'all signed up for DeepSeek yet? Who has DeepSeek on their phone? Have you tried it? Can you test it against ChatGPT? Or
Yeah, I did, and there's similarities, but DeepSeek is more specific.
Oh, really? Okay. I've been meaning to test and just see.
Yeah, it's kind of the same thing.
Yeah, similar.
Just more specific.
I've been amazed at ChatGPT. It's really inconsistent, but when it's good, it's really quite exceptional. But is it making you more productive? I don't think there's any question Excel and computers made us more productive. The stuff we were doing at UTSA, it took a while. When we first got computers, I was in an apartment with one of the guys I was working with. He was really good with computers. He pushed us fast. And then we went and worked with another department. They were accountants with ledger paper, and they were typing they were doing everything on ledger paper and then typing that in the computer, including the sums. They were typing the sums in the computer. Like, you don't need ledger paper anymore. You can just, but it took them a while to get used to the whole new system, and so it's like, it doesn't convert. You're at an extremely interesting point in time in history where we're talking about this huge inflection point. We'll see what happens. Is it possible AI is being hyped and it's really not going to come to fruition what we think? Or is it possible 10 years from now we're going to be doing stuff we can't even imagine today? It's hard to say. I saw one guy say that AI now has 120 IQ on everything. And there'll soon be 200 and 1,000 and 10,000 IQ. What happens when you're competing in the workforce with someone who has a 10,000 IQ on every single subject? it's going to make it tough for you to keep up, probably, unless IQ. It's possible Elon Musk is just a disk we put into our brain, and AI just talks to our brain, and you don't have to look anything up. It's interesting. We don't know. There's things we do today that if you told me in high school, I wouldn't have believed you. I would have never believed GPS was possible. It just seems incredible, and today we're just so used to it. What we're doing on computers today seems pretty amazing. We weren't thinking about that. So who knows? Productivity is a tough one to figure out. However, with internet and AI and robotics, we've actually seen pretty weak productivity the last 15 years. So it hasn't been shown in the numbers. This last decade here was actually the weakest. Pretty amazing, right? Given everything that's going on, it's actually one of the weakest. So we'll see. I really think the key is the service industry, education, healthcare in particular. I think retail is starting to get more productive, or at least trying some stuff. We'll see if kiosks make a difference. Do y'all use kiosk in the? Do y'all use order online on your phone for the food court? Is that saving workers over there, or is it just saving you time? That's the kind of thing. Anytime I see new technology, I'm trying to figure, do they have more workers, fewer workers? Is the quality of service I'm getting better or worse? All of that's productivity. It's what makes us wealthier. And then when you get to labor growth, that has been pretty volatile over time, although more constant than productivity, with the exception of the 2000s. I think what happened in the 2000s was we hired too many people in construction and too many people in banking, and so we had to get rid of all those people all at once. When the 2008 crisis happened, a lot of bankers lost their jobs, a lot of house construction people lost their jobs. So I think that was a correction from overdoing it here. We had a pretty decent comeback, about 1% labor growth this last 15 years, but with weaker productivity, so that means we're just getting poorer. What can you expect for labor growth? Well, first of all, baby boomers are supposed to be retiring. That should be shrinking it. AI might be replacing workers. Most of the world has a shortage of workers. China has a big problem. Japan has a really big problem. Japan is kind of just dying away. And Japanese young people are not having kids, and they don't want to have kids. So Japan is shrinking, right? Y'all have seen that story. Japan's going to be 1/2 its size probably by 2050. It's pretty amazing. China's one-child policy worked too well, and now they're like begging people to have babies again. How does the government get people to start having babies again? Free daycare, tax credits, but that's, you got to do a lot to get someone to have a kid. That's a pretty big commitment, so it's tough. We'll talk about that more when we talk about international markets. So we have a shortage of labor. The U.S. has a huge advantage in that we're near countries that still have fairly decent population growth. Europe has somewhat that advantage being near Africa, us next to Latin America. There are a few places in the world, but even Africa and Latin America are seeing drops in, even though their populations are still growing, they're not growing nearly as fast. And as countries get wealthier, their population growth tends to decline. So it's going to be interesting between these two. Is productivity going to come in and give us a lot of growth because the labor growth is going to be low or negative and offset? So when you start making those assumptions, that's somewhat you have to deal with. Not an easy time in history to forecast these things. Inflation, the Fed says 2%. Why 2? Who knows? But 2%, so maybe that's a good forecast going forward. You can see what inflation was when I was in high school. It was a pretty scary decade. Very high expense growth. We had 2022 push this up above 2%, but a lot of that decade, last 15 years, with very low inflation. And Japan has essentially had deflation and disinflation for over a decade. They're trying to get inflation up to 2%. We're trying to get ours down to 2%. So, but these are the assumptions you got to make. How fast a corporate earnings is going to grow. I tend to be in the 4 to 6% range. But you're going to have to decide on paper 3. You're going to have to decide what range. But the historical, we saw that with GDP last week. GDP's grown about a little over 6%, and these are the components of it. What's missing from this is exports, imports. which tends to be noisier and tends to be a negative number because we tend to import more than we export. But these are the three big ones. And this is, if you're an investor, these are the ones you have to deal with. You can't assume corporations are going to grow their earnings at 10%, the economy's only growing at 6%. So you're going to have to somewhat limit yourself. You can, in exam questions, since it's open book, you can actually copy these charts and put it into your answer if you like. You'll definitely be doing that in paper 3, so you'll see a little bit of overlap with those two. So historically, the dividend yield on stocks has been about 4%. Today, it's less than 1.5%. But what did I say offsets that? Firms aren't paying dividends. What are they doing now? Stock buybacks. So today, dividends plus stock buybacks is probably around 3%. It's still lower than historical, but and then earnings growth has been about 6%. So historically, stocks have given us about a 10% return. Unlikely going forward. So I assume earnings growth will be in the 4 to 6% range, and I assume stock returns will be in the 6 to 8%, maybe 6 to 9% range. Some people think it's going to be much higher, much lower, but you're really confined in the 2 to 4% on dividend yield and 4 to 6%. I don't see how you can get much higher than 6% on earnings growth. So you can see my in-between is 5%, 2% productivity, 1% labor growth, or maybe 3% productivity and no labor growth, somewhere in that range. So get used to looking at productivity numbers on paper 3 especially, but even on the exam question, if you want to type Fred and productivity and create your own charts, you can certainly do that and get extra kind of critical thinking points. Get more and more astute. I showed you how to do that a couple of classes ago. Get better just pulling the data in and graph it in a way that makes it understanding to your boss. The goal in your first job, I'll probably say this a couple of times, your goal in your first job is to make your boss look like a genius. If you do that, you'll be successful. If your goal in your first job is to get ahead and kill everybody else in the departments so that you get ahead and make your boss starts thinking that you're trying to get their job, that's not good. So your first job, your second job, you can try to take your boss out and get their job. But your first job, focus on one thing. How can I make my boss look like a genius? If you do that, you will be in great shape. You'll have someone there in your corner for the rest of your career. And it's actually pretty easy. You just watch what your boss is doing and you anticipate. If you can do that, you can do extremely well. And this is the kind of thing where you're trying to explain these. What can you do as the analyst to explain these numbers in a chart or some kind of analysis that really brings it to life? All right, any questions on this? That really and truly is what the stock market's all about, is dividend yield plus earnings growth. All right, let's talk about bucks. Do you remember DC cuts I? Duration, convexity, credit, non-US bonds, taxes, structure, relationship. You got them, the subcategories and the strategy. You don't want to not just get it on the exam, but you want to just know that permanently. That's extremely important. If you understand that, you're in really good shape. Anybody know bucks from reading the class notes? Beta. The U is almost the same as on the bond side. Non-US stocks. C. Capitalization, which is the size of the stock. And then S. Style. All right, so let's talk about bucks. All right, so the first of bucks is the B, beta. We'll talk a lot about beta, especially on paper 3. So there's two parts of beta, so don't listen to your notes. The first part of beta is just your stock versus bond allocation. Do you want to be more in stocks or more in bonds? Then the beta is specific to stocks, what kind of stocks? Right, so the first part, stocks versus bonds, if you're expecting a recession, what do you think you would do with your stock allocation? Increase it or reduce it? Reduces. That one's pretty straight. That one's really straightforward. If you're expecting a recession, go buy long-term treasuries or long-term high-quality bonds. If you're expecting a strong economy, get out of the long-term treasuries, buy lower-quality bonds, put your money in the stock market. That's very straightforward. Well, certain industries and sectors have different types of betas. So there are and here's your subcategories. You have cyclical stocks and defensive stocks. Cyclical stocks have high betas above 1. Remember the stock market, you should have had this in 3013. The stock market has a beta of 1. And beta is a relative measure of a stock's what you call systematic risk. We'll get into this more later in the class, but cyclical stocks have high betas, which means if you're expecting a recession, you don't want cyclical stocks. You want what kind of stocks? You want defensive stocks. So if you're expecting a recession, your boss says, hey, I think we're in a recession next year. You say, oh, well, we want to reduce our stock allocation and move more defensive within the stock portfolio. And write that word down, within stocks. I'm going to say that a bunch of times here. So if you're expecting recession, reduce stocks overall, and within stocks, move to defensive from cyclical.
So defensive stocks would be anything that's inelastic, people are going to buy regardless?
It could be inelastic. It really, because inelastic is more how sensitive your customers are to price. That probably does have a correlation to cyclical and defensive. I think of it more of if we had a recession, are they going to do better than average or worse than average? So the word cyclical or defensive is really, I tie it to the economy. Definitely if they have very inelastic demand, that's probably going to protect them. Like cigarettes, right? You go in a recession, people may even smoke more. Alcohol, you go in a recession, they may drink more. So you could probably raise your prices and get away with it. So that's probably defensive. But the real key is, how do people behave if there was a recession? Are they going to cut back on this industry's product, or are they going to buy more of it? So Nordstrom's, that's retail. Walmart, that's retail. But Nordstrom's cyclical. Why? Because it's higher end, it's more expensive, it's more luxury type of good. Walmart, discount stores. Walmart has actually been the king of defensive stocks. They were, I think, the only positive returning S&P 500 stocks in 2008. They did really well under COVID. So Walmart has really proven itself has done fairly well in really, really bad economies. But Nordstrom's is going to really suffer quite a bit. Durable goods, cars, heavy equipment, planes, those are the kind of things people are going to cut back on if the economy's weak. Those high-ticket item goods. I know airlines are doing horribly right now. I saw just another article today about another plane that tipped over or something. It's like, the news getting any worse for Boeing than it has been, but that's not related. That's more of an unsystematic risk. That's not related to economy so much, but cars, heavy equipment, planes, they tend to not sell well in a recession. Commodities, with one exception, gold, but commodities like steel, concrete, copper, those are production metals. If the economy slows down, they're going to come down in price and do pretty weakly. Travel and leisure, definitely people are, when's the last time you heard someone say, man, I'm worried about losing my job, I think I'll book a cruise for next week? Probably not. You might hear them say, I'm worried about losing my job, I'm not going to go to Nordstrom's, I'm going to Walmart from now on. You might hear that, but they're probably not going to book a cruise. And so retail and travel, autos, those are called consumer discretionary, which means they don't have to buy them. They can give up that, so they're probably going to cut back on those if they're expecting a recession. Defensive can be retail if it's the discount stores. Gasoline, people tend to, now gasoline can be hurt in recession. We're talking relative. People may cut back on their driving in a recession because there's fewer people working, but it won't be as big of a drop of them cutting back on buying cars. So it can be negative. Defensive doesn't mean they do great in a recession. It just means they're not hurt as much as others. So gasoline tends to do okay. Food, we tend to buy food in a recession. Consumer staples, that's kind of what these are. Utilities, people tend to pay the utility bill. They may cut back some, right? So there could be a drop in revenue, but probably not going to be a disaster for utilities. Telecom used to be considered defensive. Telecom is somewhat changed now. These firms are getting more in the media and doing other things, so it's not quite so clear. Healthcare can be defensive, although it's kind of been all over the board. Kind of depends on the type of healthcare, but those are traditional ones. It's not obvious all the time. The Modrin, in one of his videos, he talks about Ferrari. Ferrari would be here, right? Would be a high beta stock, but he says he thinks Ferrari's a low beta stock. Why would Ferrari be a low beta stock? Any guesses on that?
The customer base is.
Customer base. Yeah, what do billionaires do during a recession? They do what they do during a strong economy. Yeah, exactly. Yeah, if you're worth a few $1 billion, like $200,000 cars, it's like us buying apples at the store or something. So yeah, so it's not every car dealership, every car manufacturer, it has to be high beta if their clientele is billionaires. So it can vary, but you think about that. On paper 3, you'll have to do it. I'll show you how you actually come up with this for the stock you're going to pick to do for paper 3, but you have to decide whether your stock is more cyclical or more defensive, coming up with your beta for your firm. Some are kind of in between technology, and technology now includes communication services, so Google and Facebook are no longer part of tech. I think with Google and Meta, they're really advertising firms. Advertising does tend to take a hit during a cyclical time. Firms do tend to cut back, but they tend not to cut back as much on Google and Meta as they do on other advertising, just because it's become so standard, but it can. But tech used to be high beta, just no question. Now, and I'm not even sure technology is going to exist as a category, because essentially every firm is becoming a tech firm now. You have to do technology, so it's like, who isn't a tech company nowadays? All right, so that's the key. If you're expecting a recession, move to these lower beta stocks. If you're expecting a strong economy, move up into the higher beta stocks, and they're going to do very, very well. If you're expecting a recession, get out of stocks, reduce your stocks overall, and then what's those 2 words? Within stocks, become more defensive. You might not, if you normally have 20% defensive stocks, you might stay at 20%, but your cyclical might go from 20 to 15. So within stocks, you have a relatively more in defensive stocks. Now here's my take on it, but I change my opinion all the time. Energy, I tend to do low to medium kind of cyclical. We tend to buy oil and gas and those kind of things. That tends to be more weather related. Gasoline is a bit subjective to the economy. I ride my bike every day when COVID hit. I mean, it was wonderful. There was no traffic anywhere, so gas definitely took a big hit. Gasoline definitely took a big hit. But generally, it's definitely not a high beta type of industry. Materials is high beta. You're talking about chemicals, metals. Gold is the one exception in there, but materials is part of the whole production process. Those are things that cut back. Industrial is almost by definition are high beta. Communication services, that's where the telecoms are, but it's also the advertisers like Google and Meta. I tend to think of those as higher beta firms. Consumer discretionary by definition is high beta. Consumer staples by definition are low beta, but look how low I go. I go as low as 0.4. I tend not to go much below 0.4. Grocery stores, I might use a 0.4 for a grocery store, but I don't go much lower than that. Healthcare, you can see, is kind of midland. Financials, kind of depends. In 2008, financial betas shot up above 2 because we had a financial crisis. So it kind of depends on the crisis. If the crisis is related to banking and charge-offs and those kind of things, bank betas can shoot up quite dramatically. Information tech tends to be middling to pretty high beta. Real estate tends to be higher beta. It can vary, it kind of depends on the type of real estate. And utilities are low beta. We'll talk for paper 3 how you adjust this for debt and other and operating leverage. We'll get into that later. Utilities have a lot of debt, but they're still low beta because they're a protected monopoly, so their business will do well. I'm not saying these are sacrosanct, these are just kind of my general level. You do want to get some sense when you hear a company that you just automatically have a pretty good idea what data you use for the company, so you just have to practice that over time. So, subcategories, cyclical, defensive. Your strategy, if you're expecting recession, make sure in your exam answer there's two pieces. Your stock allocation overall, and then within stocks. So overall allocation, reduce your stock allocation, move to higher quality, longer term bonds, and then within the stock portfolio, reduce the beta of your stocks, move to more defensive companies. All right, questions on that? Here's some, this was year to date. I don't know when I did this, so I can't tell you, but we do know tech has been the big performer over the last year, or I don't know when I did these, last 5 years. That's probably at the end of last year. So over the last 5 years, tech is up 210%, where real estate's only up 15%. Last 10 years, tech's up 553%, energy's flat. It makes a huge difference which industry you jump into. Why is tech up so much? Those magnificent seven, NVIDIA, especially Microsoft and Apple. Consumers, communications services, that's where Meta and Google are. They've definitely driven that much higher, but there's a lot of others dragging it down, so it's not as strong. These aren't annualized numbers, this is cumulative, but it's still a really, really impressive number. So yeah, it makes a big difference. Now, does that mean you should avoid tech going forward? Remember in 2000, at the end of 99, it's the same picture, and then tech sold off 80%. Is it getting expensive? Definitely tech looks expensive, but it doesn't look nearly as expensive as it did in 2000. So it doesn't look like tech would drop 80%. It could certainly drop 20, 30%, but it doesn't look as expensive. The difference today versus 2000 is today the tech stocks are making a lot of money. They're producing a lot of free cash flow. Back then they didn't have earnings, but they had huge valuations, and so they sold off. So it makes a big difference which industry you pick. All right, we're gonna jump to the U and go to the C. C is capitalization. That's how big the stock is on a market value basis. Essentially the net worth of the firm, but on a market value basis, not a GAAP accounting basis. Have you heard the word capitalization before? Market capitalization? Let me real quick just see if Canvas is working. Yeah. Wow. All right, so no. All right, so this is the big question. Which company is the largest between, you got NVIDIA, Apple, and Microsoft? NVIDIA was it, and then Monday hit. Microsoft was it almost the entire year last year, but then Apple started bigger and then passed them, and then NVIDIA passed them like for 3 days. And NVIDIA this year, anybody want to, who is it?
Microsoft.
You think it's Microsoft? 3.3 trillion or something? All right, y'all remember 303. No, it's Apple now, 3.7 trillion. And NVIDIA, they dropped a lot. They have come back though. 3.4, so it's Apple, NVIDIA, Microsoft, but I think Microsoft didn't they sell off here just recently? After earnings release? Oh, that looks like an error. So yeah, I think you would have been right here, but they had a pretty good sell-off there. NVIDIA, I really think has come back quite a bit. So yeah, that was a pretty big drop, but they're almost getting back to where they were. That was a huge drop in one day, right? 17% in one day. But definitely it's jumping back. I don't know who's number 4 then. Maybe Amazon? really don't know. Amazon's 2.4. Anybody know who number 4 is? Yeah, we can see. I don't think they're quite there. Tesla was getting up there and then fell off. They're not in their league, but definitely getting up there. 1.1 trillion. Yeah, that 3.6 trillion, I think I told you all this before, but when I graduated from college, the entire stock market was less than 3.6 trillion. So Apple today is larger than the stock market was when I graduated from college. You're thinking that was like, 87 years ago, but it wasn't that long ago. It's pretty amazing how large these firms are. Is anyone larger than Apple? So what's the oil company in Saudi Arabia?
Iraq or something like that.
Can't remember the name of it. I can't remember its ticker. Someone tell me the name.
Is it Aramco?
Aramco. I think you can see their valuation, but it's not in U.S. dollars. So I'm not sure if that's what that is. So I don't have great faith. It could be in another currency, but anyway. I don't know what this chart means either. But it's possible Aramco is larger. I doubt there's any other firm out there that would really come close. If you think about it, Apple's larger than probably most of the world's current stock markets. If you look at all 90 or 100 of the world stock markets, it's probably larger by itself than most of those. So capitalization is breaking the market into a few categories: large capitalization, medium cap, small cap. Those are the ones we're worried about. On the exam, I mean, you can talk the 20 billion or so, but the amount changes over time as the market moves. So 20 billion might be more mid cap today than it is large cap. Mid cap, I say 1 billion. 1 billion would really be small cap today, but again, it varies over time. Small cap, 100 million, that's pretty small. Micro cap usually is maybe a firm that just IPO'd and it's a really small firm, so it just went public, or it's a firm that's going out of business. And there are firms going out of business, and especially penny stocks, those are firms going out of business. I don't know if I can think of a penny stock right now. J.C. Penney even has penny in its name, but it's not letting me show it. Yeah, there are stocks that are penny stocks because technically there's no money there. There's nothing for the stockholders are going to get wiped out. It's a penny stock because the stock still trades, and that's pretty common when a firm goes bankrupt. That the stock will keep. GM did that. GM trade even though we knew the stockholders you can get nothing. And penny stocks can make you a fortune. You can buy it for 20 cents and sell it for 40 cents. Why does it go from 20 to 40? Well, if someone shorted the stock, say at 20 bucks, it fell to 20 cents, so they're really happy, right? They sold it for 20 bucks, but they want to close their position out. How do they do that? They got to buy the stock back. What happens when you buy a penny stock back? You cause its price to go up. So there are people who do penny stocks, and it's really just gambling. They're hoping some short seller is going to want to close their position. They can double their money if they're a small investor. But I don't consider penny stocks to be an asset class. Micro cap, you really got to be careful. Most of those firms are probably going to go out of business. So the typical category is large, medium, and small cap. And again, the amounts are pretty iffy, change over time. But these are three distinct, remember parsimonious, these are three distinct asset classes. They do have different returns and risk. They are very highly correlated to each other. So you don't get a lot of diversification, although I've been pretty shocked at how much different medium cap and small cap have been the last few years. Small cap used to be the hero, used to be the outperformer, and they've really had a horrible decade of it here, which is why I'm investing in small cap. I think they really look cheap to me. But mid cap's actually done fairly decently well. They tend to be highly correlated. So the key is the risk-return trade-off. Large cap, now be real careful in the exam. People say large cap have low returns. No, I'm saying in the order, large, medium, small cap. Large cap they have really good expected returns, but not as high as small cap. So relative to small cap, large cap tends to have the lowest return, but also the lowest risk. Small cap tends to have the highest expected return, but the highest risk. And then the asset allocation is pretty simple. You expect a recession, you don't want small companies. They're the ones that are going to go out of business, really struggle. So if you expect a recession, reduce your stocks overall in what are the two words? Within stocks, move more to large cap versus small cap. Right? Make sure those words within stocks, especially on the second exam question, you're going to need to say that. Within stocks, increase the large cap versus the small cap. You would somewhat expect that anyway, just logically. The number one U.S. stock class, we'll talk about value versus growth, but small cap value, that's been decimated the last 10 years. It just hasn't worked. Really cheap. Between small cap value and emerging market stocks, those are the two cheapest out there. They're both have some disaster scenarios behind them. That's one reason they're so cheap. Questions on capitalization? So you can limit yourself to 3 categories here. The last 2 are really not that critical. All right, so here over time, large caps made 10.25, mid cap 10, and small cap 9.6. That's the last 20 years. But if you look at it right here, when COVID hit, they were all tied, and now large cap and mid cap are ahead of small cap. So small cap has really trailed the last several years. They were all right together. Even mid cap and small cap were outperforming large cap, and then the last few years, large cap has really outperformed. If you look at them relative to each other, small cap really is cheap versus this historical. We'll talk about relative value analysis later, but small cap looks really cheap. So maybe it's a little confusing. I say C for capitalization, which is the size of the company, and now I use S for style, so don't get confused. S is not size, S is style. C is capitalization, which is size. So S is style. So if you're not familiar with style, we break up the market between growth and value companies. I don't know if anyone was at our dashboard team meeting today, but they had a guy from Frost who manages, he's an analyst at Frost, and they have a value fund and a growth fund. So what are growth stocks, what are value stocks? So growth stocks have high expected earnings growth, but they're also expensive, which would make sense, right? If firms are expected to grow very fast, you're going to pay more for them. So they're expensive companies. Value stocks have low expected earnings growth, and thus they're cheap. So you can think of growth in value stocks, or you can think of expensive and cheap stocks. It kind of depends on how you want to define it. The one thing I want to warn you on is the word value does not mean quality. Growth stocks are much higher quality than value stocks. All right? Value stocks are low quality. Value stocks are struggling, they have low growth, they have low returns. So value stocks are not high quality. That's really key when you talk about the strategy. Growth stocks are much higher quality firms. So if you're expecting a recession, would you rather have a high quality firm or a low quality firm? I'd rather have high. So this may seem strange to you, but growth stocks tend to do better in recessions. Value stocks tend to do better in strong economies. Just because value stocks tend to be the weaker companies, they need stronger economies. A lot of them are firms who may be going out of business, and if you have a weak economy, that's what's going to take them under. So value stocks do better in stronger economies and when interest rates are rising. Why is that, interest rates? Well, growth stocks, because they're growing so fast, a lot of their value is way out into the future. What happens when you discount something that's way out into the future? You change your discount rate, it has a huge impact. So growth stocks are more sensitive to changes interest rates because so much of their value is way out into the future. Value stocks aren't growing very fast, so a lot of their value is near term, so interest rates don't affect them so much. So if you're expecting a strong economy with rising interest rates, value stocks typically do better. Now, it's not always because of what's happened with the Magnificent Seven here recently, but that's the general thought. I don't know what that is. Hopefully it's still okay. You'll see my face come on the video. Hopefully I can take that out. Now, I was surprised when I discovered this. I did this at UTSA. I was like, there's definitely, if you graph value growth stocks, and the way I like to do it is say, you put one number, $1 that goes up with value stocks and goes down with growth stocks. So it just takes the difference. So if growth beats value by 1%, you're going to be down 1%. If value beats growth by 1%, you go up 1%. If you graph that over time, it's really pretty amazing. When I looked at it, it was like these really predictable 7-year cycles. Value outperforms, growth outperforms. Value outperforms, except for the last 10 years where growth has just really taken off. But there are those cycles similar to our economic cycles. But the other thing I tested was who does better in a recession. I was really thinking value stocks, but I was surprised growth stocks do better. And you see that as well. Other people say that same thing. Right now, value stocks are really cheap. This year, value stocks are outperforming. So far, they didn't this last week, but year to date, they're outperforming. But we saw that last year, and then growth took over again. Nvidia came back, Microsoft comes back, so it's been tough on the value side. Long term, value has been the place to be. People like buying cheap stocks, not expensive stocks, but growth has really dominated here. All right, so there's a couple of things there. Growth stocks do better in weak economies when interest rates are falling. Value stocks do better in stronger economies when interest rates are rising, but this is generally, it's not 100%, it's not predictable. GMO, which I really love their website, I recommend register on their website, it's gmo.com. They've had several articles on value versus growth. They're pushing value right now. And they even had the argument, they said, why would you buy value stocks? This was back in 2023 when people were expecting a recession in 2024. So they're saying, why would you buy value stocks if you're expecting a recession and interest rates are rising? And they said, yeah, that's true. Value stocks tend to do worse in a recession. They tend to, or when interest rates are falling, right? A recession, interest rates falling. Why would you want value stocks? And they said, yeah, we agree with that, except value stocks are so ridiculously cheap right now. Even with the recession, even with interest rates falling, they're still going to outperform because they're so cheap. I'm kind of in that camp as well. It just hasn't worked yet, except for this year. So far, it's not massive. It's not like value stocks are up 20% and growth are up 2%. It's like 4% versus 2% or something. It has not been a massive. But value stocks are really cheap right now. All right, questions on value versus growth? There's a lot of people who don't like value versus growth, and they don't like that distinction, but it is out there. So if we do well, I always do Fidelity. Contra funds, I know that fund really well. If you go under profile, you'll see the style analysis. It's been called the style box Morningstar. So Fidelity is large stocks, large growth stocks. So this mutual fund is a large growth. What is this fund? Large cap value. What is that fund? And don't say blend. What is that fund? You remember the word we use, not blend. Morningstar is wrong here. So it's large cap. We don't call it blend, we call it core, C-O-R-E. So this is a large cap core fund. I'll just click on one and we'll see what comes up. What does that one do?
Small core.
Small cap core, all right? So this is Morningstar. Morningstar does something, if you take my risk management class, they're actually going to do a style analysis in there and actually do the math to figure out their firm is large cap, small cap, core value. But this came around probably the late 80s, early 90s when we started doing this value versus growth. So there's a lot of managers don't like it. They like to switch between the two. But you can see it's become pretty stable part of the investment world. All right, so last one, US versus, well, here's the numbers. You can see the 3000 growth index has done the best. 3000 is large and small. The S&P 500 is right there, and look at the value. Here's value down there. Value does outperform. Here's a place where it's outperformed. You look at it over time until right here, you had these pretty predictable cycles, but who knows? Value's really, really cheap right now, but some people are saying the world's changing. Technology is going to take over, but we were saying the same thing in 1999, and that reversed, right? I can't show you 1999 in here, but if I did, you would have seen a really huge outperformance for growth in the 90s, and then by value in the 2000s. That was a big, big shift. So but that's a big difference, right? Growth is up 11.7%, value is up 8.3%. That's a pretty huge, so on an annual basis, pretty huge difference. Almost twice as much. You'd have almost more than twice as much money if you'd invested in growth versus value. All right, let's talk US versus non-US. We said with bonds, most people don't consider non-US bonds an asset class because of the currency risk. But most people do consider non-US stocks an asset class. They really have come. Now that wasn't true in the 70s, but starting in the 80s, probably because of William Sharpe and the work that he did, non-US stocks became pretty stable. Why does it work for stocks but not for bonds? Well, with bonds are not very volatile. So when you throw the currencies on top, the currencies take over. Non-US stocks are pretty volatile. So when you put the currencies on there, they somewhat match each other up. So the currency doesn't dominate nearly as much. And the currency almost gives you some protection, some diversification. So we break stocks into 3 categories, maybe 4. So you got US stocks, that's where you talk about beta, capitalization, and style. Then developed markets, these are larger, more stable, developed economies. They have similar returns to US large companies, but currencies and economies give you some diversification there. Then you have emerging. Emerging might be the cheapest asset class out there right now. These are fast-growing economies or tanking economies, one or the other. They have developing, not developed, but developing markets. They have high expected returns because they're expected to grow their economies faster, but very high risk. They do provide some diversification benefit, but not as much as they used to because of what's going on with globalization. Certainly China as an emerging country is more tied to US economy than it's been in the past. And then if you really want a roller coaster ride, there's frontier markets. These are economies that have a stock market, but there's something seriously wrong, maybe hyperinflation, maybe there's some totalitarian government is taking over. Bangladesh has a stock market. Are you investing in Bangladesh right now? They just had a coup, they kicked that woman out, I forget her name, after she had been a dictator for what, over a decade. Syria might have a stock market. Is this a good time to invest in Syria? Argentina has a stock market. it's actually doing pretty well. Its stock market's doing pretty well. Its economy is coming back. So they're not. Argentina is probably an emerging, not a frontier, but Syria, Bangladesh might be frontier. So frontier is usually not an asset class for most people, but the emerging has definitely become an asset class for most people. Most people do look at emerging as an asset class. Here's how Standard & Poor's breaks up different groups. So the minimum, you think about these numbers. The entire stock market must be worth at least 2.5 billion. What did we say Apple was? 3.6 trillion. So that's the entire. The additional criteria is 15 billion, but even that's pretty small. So not asking for much. Turnover, that's how much stocks trade on a daily basis. It needs to be greater than 1 billion. Apple probably trades more than $1 billion in a few minutes. So these are small numbers. And the exchange development ratio, what they're saying there is you take their stock market and divide it by their economy. Their stock market needs to be at least 5% of the economy, which is really, really small. In the US, it's pretty close to 100%. So those are criteria. For frontier markets, they have to have at least 2 of those. You can't be emerging or developed if you don't have all 3 of those. Emerging, that's where they say you've got to have at least 15 billion to be an emerging market. So if you're less than 15, but you have 2.5, you'd be frontier. And then you have these other criteria you have to have 3 of. Developed, you have to have all of these. Settlement, T+3, the United States, I did a lot of trades that were T+0. So what that means is you trade today and the money moves today. So most of US history, it was T+3. You trade today and you move the money in 3 days. But I did a lot of trades where you trade and then they move the money today. The debt of the government has to be BB or higher. So BB plus, that's just right on the cusp. It's below investment grade, but just on the cusp. Cannot have hyperinflation. You can't have restrictions on who can own your stocks for non-citizens. And then you have to have freely traded foreign currency. For developed markets, you have to have all of these. For emerging, you have to have 3 of those. And then the last one is your per capita must be greater than $15,000. Let's see if we can find this list of countries per capita GDP. Let's see if we can find these. This is nominal. Monaco, you know where that is, right outside of Italy there. Liechtenstein, Luxembourg. Those are the 3 you see together. I've thought about moving to Luxembourg because I really like mountains. But I don't know. You want to walk around where the median, the average person's net income is $257,000. You get there, get a job, pays $180,000. They're like, oh, you poor person, I didn't pay the bills, man. So United States is right here, 82,000. So there are quite a few countries ahead of the United States. And then you get down to the bottom. China is at 12,000. I do a lot of work in Costa Rica. They tend to be around 5,000. I don't know if I can find them in here. India, where I mentioned India, right? India is definitely growing faster and moving up, but they're 1/7 the wealth of China. Then you get down below 1,000. Now, poverty used to be defined as you make less than $2 a day. $2 a day would be what, about $700 a year. So now you're getting in people in extreme poverty. Burundi, 200. Afghanistan, 353. So yeah, so a lot of countries that you get less than $1 a day. Syria, obviously just coming out of a war. So it ranges pretty wide. I don't know why they're out of order. Maybe they're sorting by that column. What is that column? Oh, they're just different estimates. So it ranges pretty wide. The U.S. is one of the wealthier countries out there, but there are some exceptions, some that are larger. Not radically though. So in the U.S., just of our large population, you would expect this to be a little more varied. U.S. still has more billionaires than other countries, although China is certainly catching up on that. China does have more billionaires in its political group. There's more in their kind of legislative group, whatever that thing's called. There's more billionaires there than are billionaires in the U.S. Congress, but overall, there's more billionaires in the United States. So GDP per person, it's a pretty important gauge. 15,000. You can see China. China is not a developed market, and it has several problems in this category, and then it's still below the 15,000 here, but it could start getting closer. Here's how different world markets have done. So the United States has really dominated, especially the last few years. They're the only one with a double-digit 10% return. Developed markets is way down here, the 6% return. Emerging markets is the yellow, way down here. China was doing great, and it's come down, which is one of the reasons why emerging has not done well, because China has really weakened. Japan, I don't know if y'all know the story of Japan. So Japan hit a record high of 40,000 in 1989, dropped 90%. And last year in February, after 30 years, it finally hit a new record. And now it's 7% off of that since then. So it hit that new record, and it's come off. But you can see it, right? Japan hit it, and it's come off by even more, dropped down. I don't know why I have the Nikkei in there twice. Now, does this argue to buy U.S. stocks, or does this argue to not buy U.S. stocks? How would you argue this? It depends on your view, right? Is the U.S. doing well because we're overpriced, too much hype, or is there something special about the U.S. economy that's giving us a huge advantage? We'll see what tariffs and those kind of things do to the U.S. economy versus others. But China definitely, I should have put India in here. China definitely has been struggling to get their stock market going. There's times where people say invest in China, it's the place to be. As you can see, it just doesn't stay up there. And so they're on a pretty long downward trajectory. This is through September, so I should have updated these, but I'm using Bloomberg. Bloomberg, this is the COMP function, which is a great function to be able to compare things. You might use it on your paper too, definitely. This is where productivity comes in. So productivity is all about how easy it is to run a business. Unfortunately, they stopped running this ratio. So it's a few years old. They stopped running it mainly because Russia started playing with the numbers, so they go up higher on the list without doing anything. Just it's like, oh, if we score better on that, okay, we'll make that number go up artificially. So that was part of the problem. But these are the scores of doing business: New Zealand, Singapore, Hong Kong, Denmark, South Korea. The United States ranks really, really high here. I don't understand why Georgia ranks high there. I don't think they would today. At the bottom, Somalia, Eritrea, Venezuela, Yemen, Libya. This is pretty huge. We've started a few businesses in Costa Rica, so I work there. It is horrible starting a new business in Costa Rica. The paperwork is terrible. The requirements take forever. Training requirements. Just setting up a bank account can take months. It's a horrible place to do business. Costa Rica will be a much wealthier place. They just made it easier for people to do a business. A place like India has really struggled with bankruptcy laws. If you start a business and it fails, but you can't stop it because there's nowhere to go bankrupt, you're not going to enter a business. Right? If you got to keep running a business even while you're losing money, you're not going to do it. US, it's pretty easy to file bankruptcy, go out of business, shut it all down, and go try. And there was a lot of people who bankrupt 3 or 4 firms before they finally got it right. What I like about this is they show you where they're measuring what are the categories, but 2020 is the last time they've done it, and there's not like a new one that they've added. So you can get into this report and really look and see how do they classify the different pieces. See if I can find it real quick. But starting a business, dealing with construction permits, getting electricity, getting your property so it's in your name, borrowing money, protecting minority investors, paying taxes, trading across borders, enforcing contracts, resolving insolvency. Those are the kind of things that they're looking at. I wish they still did this analysis because I find it pretty fascinating, but it was being gamed, the numbers are being gamed. But you can see this list makes a lot of sense, right? These are the kind of things, if you were to start a business, you'd be interested in making sure you were doing had strong numbers in. Where does China do poorly? Property ownership, getting credit, enforcing contracts, resolving insolvency, they get no marks there. I said India was weaker. India just passed a law to fix their bankruptcy issues, so they probably have improved on that quite significantly. All right, we'll talk more about overseas, and we'll talk about education and some other things. So there's quite a bit more we'll do here, so we'll finish this one up. I don't know what the video is going to look like. We may have someone sharing their exam 1, question 1, this next class, so hopefully I'll have that. All right, I keep wanting to turn Zoom off, but I can't. Today, we have one student volunteered to show her how far he's gotten on his exam 1, question 1, so we'll look at that. Finish up stocks, start on alternatives. So I haven't looked at this yet, so hopefully you're making good progress. See how far he got. Looks like he's got the fixed income done pretty well. Stocks even got started on US. So yeah, he's fairly well caught up to where we are. So your students ask how many pages it would be. I'll never answer that question. I wouldn't suggest you do with that. You're with your boss. Hey boss, you asked me to do an assignment. What's the minimum what I can do and get away with it and you'd be acceptable? That's not a good question to ask your boss. You should never ask your professors that either. Do what's needed. Longer doesn't mean it's better. One page is definitely not going to be good unless your font is like 2 or something. It's just no way you can do it in 1 page. 50 pages is probably overkill, but you decide. That's part of critical thinking. So you start off, what is portfolio? This is a pretty short answer. He's got quite a bit here. It's collection assets designed to achieve a specific financial goal. Address key questions. So it's some specific financial goals. So that's the key. So that looks good. It's important to identify the reason. For most people, the why is some future financial obligation. Horizon's really important in there. So he's got that. You can definitely talk, give examples. If you want to talk about the risk tolerance questionnaire, it's fine. I'm not really looking for that. But what are you investing in, or what can you invest in? Here you're looking at asset classes. Your beta risk is fine to put in there. Useful tool, and definitely talk about style analysis, the R-squared, have that in there. You don't have to have the word parsimonious in there, but you want to be stingy. So he's got that covered very well. He doesn't have the how in there yet. He's probably going to add that to the end. Some students do the how question now, or you can go right in. Just the thing I'll notice is when students don't put the how question here, they sometimes forget to put it at the very end, and so they completely miss it. So make sure you either put the how question here and then say getting back to the asset classes and then talk about that. You got the major asset classes in there. So he's got those, cash, the definition of cash, examples. And then definitely want to talk about, and I don't know if it's in here, reinvestment risk versus price risk. He mentions reinvestment risk. Make sure you define it when you talk reinvestment risk and price risk. I would, define cash. I don't know where you put it in there, but somewhere you need to say cash versus fixed income. So that you can probably add in there, make it really, really clear. Cash and fixed income. If I were you, I'd probably start off saying, okay, there's 4 major asset classes. The first 2 asset classes are cash and fixed income. Cash and fixed income are both loaning money. What distinguishes them, talk about that, and then talk about cash, then talk about fixed income. That's the way I would do it. Just get it out of the way up front, because really cash and fixed income are the same thing, except for the reinvestment risk and the price risk. All right. So make sure that's really, really clear. That is one of the things on my rubric is the reinvestment risk versus the price risk. Remember, cash has high reinvestment risk, low price risk. Bonds have varying degrees of price and reinvestment risk. So he mentions it, but he doesn't really define it here. He says minimum price risk. So he kind of has that, but make sure on the bonds you make the distinction there on the other side. Duration. So what we're looking for here is a definition. So he needs sensitive interest rates. One thing you would definitely want to add is that formula minus duration times the change in yield. That's an important formula. He may have it. I'm not reading as closely as I will when I grade it. He gives the categories, short-term, medium, long-term, the key strategy. Well, he has the formula here, so he does have it in there. When rates rise, however, when duration is valuable to it, does account for all risk. So just a whole long duration when expecting rates to fall. So he's got that in there. So it looks like it's pretty well covered. Convexity is how bond duration changes response to election yields, relying on solely duration. All right, he's got that covered pretty well. Diversity. Yeah, you definitely have to go back to optionality of bonds. Why do you get negative convexity? You definitely have to talk about there's some embedded option in the bonds. You can use mortgage backs as a good example there. So he's got that covered, looks pretty strongly. Yeah, quite a bit. You can go in quite a bit of detail here. Now, where is his strategy? I'm not sure where the strategy is. Price becomes more volatile. It may be in there, but I'm reading so fast I can't tell it. So you got to make real clearly, if you expect interest to become more stable, you can sell convexity, get that higher yield. Expect it to become more volatile. You want to buy convexity, avoid those ones. I don't see that in there. It might be in there and I just missed it. He has OAS in there, which is nice. There's a lot you can do on that by just looking up and rewording Wikipedia or something. Credit. So here, I would clearly say you have high quality sets of governments, medium quality like triple B, and low quality like high yield. Make those 3 categories real clear. He says high quality, medium quality, low quality, so he has that in there. High quality, longer duration, have a recession, so he's got that covered well. One thing to make sure you have on credit, he might have it in here, but I'm not seeing it with the fast read through, is credit is also your decision on which industries or sectors to be in or out of. That's part of the credit. Certain industries do really well, like, we saw energy really struggling in 2020 and then came back in 2022. So certain energies, obviously, a lot of consumer stocks struggled during COVID. So, the industry selection can be important. US versus non-US. currency risk dominates. You found a chart. You can bring in extra charts like that. That's fine. So yeah, he's got a lot more there. He probably get full credit there. Tax consideration, you do absolutely want to have this formula in your answer. Talking about there's some stocks are taxable, some are not taxable. You make the decision by looking at that. So that formula is really important. Structure, looks like he's got that covered well. And he's got the liquidity premium part of it. That's good. Some bands hate inflation. So we created the tips. You want to talk about the tips. You know, they pay a real yield plus principals adjusted. Pretty straightforward. Stocks, equities. So here's where he's going to definitely have to beef this up, right? So, yeah, this is probably where he kind of ran out of steam at the end. But you definitely want to say the expected return on stocks is dividend yields plus earnings growth expected. You can add in the stock buybacks. You can show a chart that shows that. I got that one chart that shows that stock returns until here recently have followed that pretty well. You can definitely say that earnings growth is tied to economic growth. I got a chart for that. And then where does economic growth comes from? All of those pieces belong in there, all of those charts, right? You're going to put all of that in paper 3. So whatever you write for the exam question, you could probably copy and paste in the paper 3 because you're going to need to say all of those charts that I showed you. There's 3 of them. You need all of them in your answer here. Beta. Yeah, you got a high beta, low beta, give examples. And then the strategy. Recessions might involve reducing overall stock exposure and lowering portfolio beta. So he's got that covered. Capitalization, small cap, mid cap, large cap. And then your strategy, large cap during economic slowdown. It's got that. Style, growth and value growth or price, high expected earnings growth tend to be valued at a premium. Generally, growth stocks perform better in weaker economies with low interest rates for his value stocks. So I think he's got that covered really well. U.S. versus non-U.S. Developed markets, emerging. Do mention currency somewhere in there. Yeah, I mean, this would be a strong exam. There's a few things you could do to beef it up a little bit, but it would definitely be pretty strong. All right, your answer is going to be very different, right? Because it's going to be in your own words, but the categories are going to be really, really similar. I'm trying to give you a template that you can draw right off the top of your head. So any questions on that? Does that help to see an example? If anyone else wants to do that, let me know. I don't mind showing another one. I might skip to stocks and go from stocks to the end. All right, good. Thanks for that. Okay, so we're doing bucks. So you had beta, capitalization style, and now we're going to talk US versus non-US. We talked to different categories. Right now, emerging is the one that's just looks ridiculously cheap, but there's some reasons for that. With all the tariff wars and all that going on, it may not be the best time. We talked about the classification between frontier, emerging, developed. Developed have to have quite a few things, but none of these are like exceptional because we're talking only $15 billion in capitalization. You know, developed criteria, US well goes beyond that. China struggles in some of these down here, but is getting closer, so it's possible China could move. I don't keep track of who's moving in and out of developing emerging countries or even frontier. So I don't know what the last country was that moved from emerging to developed, maybe South Korea or something like that. But yeah, it's not like it's advertised, but you can find a list of who's developed, frontier, emerging, find those lists. You would probably find most of them to make a lot of sense. There's some that are kind of on the edge. Here's how they done. So the US has dominated, but not all the time. You can see for long periods of time, the US was in 3rd or 4th place. And here in the last few years, the US has really dominated. The green, Japan came back. We talked about that, and now they've since have sold off. Emerging was the strong player, and they've really weakened here quite a bit. I did the Nikkei twice. When you look at the Nikkei in and yen, it was up 381%. In dollars, it's up 259%. So 1/4 of your return you would have lost because of the weak yen. Can you hedge that? You can. You can hedge. Some people, there's a big debate when I did the CFA exam, they had an entire article on should you hedge currency risk with uh, international stocks. Most people say no. That article we read for the exam, I didn't think it was all that valuable. They said you should hedge if the currency is going to weaken. If it's not going to weaken, you shouldn't hedge. I was like, yeah, I should buy a stock if it's going up. I shouldn't buy if it's going down. That wasn't real helpful to me. But it does make a big difference. Why? Because the US dollar has strengthened so much. And so that makes a big difference. So when you see it in the yen, that's called local currency return. But if you convert it to dollars, that's what you actually get as the US dollar one. So if you buy Japanese stocks, you're going to get Japanese stocks plus or minus whatever the yen does. So you would have gotten 120% less return, or a good 150 basis points less return, just because the yen. So that can be really important. If you think the dollar is really strong right now, maybe overpriced, that would be another reason to buy international stocks, just to protect yourself.
If you have that risk, why would you buy Japanese? This might sound like a specific question, but just like, why do people buy the Nikkei or the Japanese stocks if US dollar is so strong?
Well, it hasn't always been. So there's been periods when the dollar's been pretty weak. I can't show you the dollar here. If you go on the Bloomberg and type DXY, that's the US dollar. It's had periods of incredible weakness. And so it can protect you. You can see, like in some points, like right here, the 2008 crisis, US was somewhat at the bottom, right? And the others were doing better. That wasn't all currency. But some people think the US dollar, the US dollar is right now is about the strongest I've seen it in my lifetime relative to other currency. Switzerland's always at the top. The US has typically, through most of my lifetime, been right in the middle. So if you're worried about the US dollar being overpriced, right now is probably its highest strength that it's had in decades. And we have a president and vice president saying they want to weaken it. So you could certainly make an argument that one reason to go international is because the dollar is so strong and might weaken. But I don't know how the yen has been so weak for so long. When is it going to shift? I don't call currencies very well. That's a really tough equation to make. But that is part of your equation. That is part of what you're making a decision on. We talked about the ease of doing business. Productivity is pretty critical. I can show you the most productive countries in the world, but you're going to notice the most productive countries in the world are the same as the richest countries in the world. There's a one-to-one match. So if you look at productivity, so what I can't show you is the change in productivity. Which countries are showing the best improvement in productivity? I can't show you that. I don't have that data here. But we saw Luxembourg was the richest country. They also produced the most per worker of any country out there. The U.S. is up there. There are some interesting countries up there. Guyana. I don't know if it's because they just discovered the oil and all that and then they're right next to Venezuela, so not necessarily the greatest placement in the world, but there are some interesting names up there. The other thing you have to watch out for is birth rates. We know birth rates are falling. So if a woman has 2 kids in her lifetime, that's not enough to keep the population going, because you think it'd be enough, right? You got a man and woman that have a kid, so that replaces one of them. They have 2 kids, that replaces them. But some of the kids won't make it to adulthood. So you have to have like 2.4, 2.3 kids just to maintain your population. You do see some countries, especially in Africa, still have pretty high birth rates. In fact, all of these are in Africa. When you come down, you start seeing a few well, you're still seeing a lot of Africa, some Middle East. But then you start getting down into the twos. And then you get below the replacement rate. So these are all countries, even India, these are all countries whose birth rate is less than enough to keep the population stable. You even see countries like China, in the United States, 1.7 below our birth rate. Brazil, Canada, I mean, some countries you would probably be surprised to see there. Japan is near the bottom. Look at that, less than one child. China is only 1.2. I mean, China has a problem with the one child policy. I think there's like 118 men to every 100 women. So there's like 18 men that they have no shot. They're not finding anybody. There's just not enough women because the one child policy, they had a preference for men. So that makes it even more difficult. Japan, 1.3, we know they're shrinking. So I don't know about if Mexico right next door to us, 1.8, even they're not all that high. That's 2022. So we're not having as many kids we used to, and countries like Japan and China are begging people to have kids, and it's really tough to do that. It's hard to get people, it's hard to induce people to have more kids. Usually as people get richer, they have fewer kids and they spend more money on the few kids that they have. If you're agrarian, you're farming, you know, you have kids just so you can get some workers. That's kind of part of the deal. So the world is definitely shrinking. When I was growing up in the 70s, we're like overpopulation, overpopulation, overpopulation. Now it's the exact opposite. There's a great TED Talk. It's really old. So you might look for this guy. It's this guy right there. It's this guy right here. You're looking for him. I don't know his name. Hans Rosslin. This is a dated TED Talk. I don't know if he's updated it, but it's really good talking about where the world population is going. He talks about there's a natural limit around 10 billion people where you just can't go any further than that. And he explains it with boxes. I think it'd be worthwhile actually go back and listen to this TED Talk, even though it's several years old, because it was really interesting. Population is pretty important. You talk about how fast a retail company is going to grow their revenues. It's going to be population growth plus inflation. That's about all you can do. Walmart can't grow at 12% its earnings. It can grow with population and inflation. That's about all they can do. There's not much more to it. If population growth is negative and inflation is 2%, that's not much growth for retail companies. And he makes the argument where we could go with that. So on the international side, it's pretty important to understand populations, productivity, and then the last thing is education. We have a former student of mine, Corey. He's making quite a wave. He just published a book. I read it. It's a really good book, but boy, he is so hated by the public school side. He's pushing reform, public education reform. He's gotten Texas now doing vouchers, trying to get vouchers passed. The public schools don't like him, but I love his analysis, mainly because the status quo, I think, is just so horrible. We got to do something, and status quo is pretty bad in the United States. We rank, this is pretty old here, getting more current, but we rank pretty low on math. I don't know how we rank that high on science, because my science teachers were horrible in high school. I learned very little science, but the U.S. does not rank high. How do we rank on spending per pupil? Number one. No country spends as much per child as we do on public education. So it's kind of like our health care system. We spend more than anybody else. We're pretty average in our healthcare. On education, we spend more than anybody else. We're pretty mediocre. So somehow we're spending a lot of money and we're not getting much for it. So the process needs to be shaken up. If you don't believe me, read this book. It's a great book, The Case Against Education. It's a really good Brian, I forget his name, Brian Kaplan. You want to be depressed, read that book. He studies how much did we actually learn in public schools? How much do we learn in college? And his the studies he shows, it's pretty pathetic. How little we learn, but with all the money we're spending. Have y'all seen the interview on the street? Like, I love it. Like, what's the largest country in the world? Oh, Asia. It's like, no, it's not a country, but yeah. Or what's the largest country? And they'll mention Chicago or something. And you're like, where did you go to school? It's kind of crazy. So what can we do to shake up education? There's several books on that. You can see the same countries tend to rank up there pretty high. Singapore, Hong Kong. I'm not so sure they're the greatest because Singapore, their poor students are so burned out when they leave high school. They're just like, they're done for the rest of their lives. They've been so overdone. Y'all have heard a lot about the Scandinavian countries where they have no homework and their kids do really well in school, a lot of free time. There's been a lot of studies. There's some great books on there on how we should change our education. There are some experiments going to US I think are pretty exciting, but something needs to change. But the problem is you have so many embedded groups that benefit from the current system that they fight hard to prevent anything from changing. But this is a huge issue for y'all to think about when y'all have kids. Are y'all going to do public schools, private schools, all the other options? Who knows what it's going to look like. COVID was a huge wake-up call because parents started watching what their kids were doing in their classes on Zoom, and they were kind of horrified, and so that caused some issues. But it's interesting. Education needs to change. Well, AI changed this. We have a tutor. We do an educational program in Costa Rica. UTSA students, we raised money and bought them several laptops. She uses a lot of online sources, and AI is becoming more and more popular in that. What AI is doing, like with math and English, is the student sits down, starts typing, and AI figures out where the student is and changes the whole curriculum to match them, to make it challenging, but not, you know, just gonna overwhelm them. That's pretty exciting. There is a great book. Boy, I shouldn't be advertising these books, but they're really good. Longram, can't remember his name. I have to get this guy's book. It's on my phone. But he went out and asked, where should we be spending our money? He's an economist. He's got I think it's the Copenhagen project, but I can never spell Copenhagen. Here it is, this right here. And their entire study is out there, so you can actually go there. And what they're asking is, where's the biggest bang for the buck? Where should governments be spending money? He has a TED Talk, which is probably the least popular one ever. You should have heard the gasp when he was talking about it. But education is one of those things he says we can do far better. And he talks about where we should spend the money. So this book, really, really good book, but this chapter in particular, where we're having the best success. And by success, he's an economist. So it's where we spend money and get the biggest bang for the buck so that you can spend money and actually get something. And there are some pretty exciting things going on there. He talks about tuberculosis and malaria, which are the two biggest killers in the world. Migration, child immigration, immunization. So it's a good book. He's got a book where he goes through each one of these, but then this website actually has every one of these studies. The details is on their website, and you can get into it in detail. So those are the kind of things you're looking for. Where should we be spending money to increase the quality of life and productivity and all those kind of things? That's where governments be spending. That's not where they're actually spending. So, you see a big difference in those two. We'll see. Your kids are the ones that are going to have to worry about it. So where do you invest in the world? Well, the US has been dominating the last 10 years. Over the long term, developed and emerging have done pretty well. Emerging has had its huge rises. Right now, emerging has been the weakest one, and it's probably the cheapest one. Some people say throw all that out and look at things globally. Don't look at large cap in the United States, look at large cap the entire world. Look at large, mid cap the entire world, small cap. Forget about location, just focus on capitalization. And there are funds out there. I think Vanguard and some of the others do have, BlackRock do have developed market large cap, developed market small cap. So you can actually get to that level. That gets back to that parsimonious. Does that help you with your asset allocation? Some people say, well, it's kind of a combination of the two. There are some sectors that are very, very global, like energy. So there's no reason to do energy stocks in the US. You might as well just do energy stocks all over. So put British Petroleum, Exxon, Chevron, put these companies all together. But there's others industries that are very local or regional, like consumer services or restaurants or those kind of things. Those keep them in the country. So some combination. You're after parsimonious. What is it that best explains risk and opportunity around the world? So don't have so many categories you can't keep track of it. What I've shown you in this, the BUCS, is still the most common approach by far. But there are people thinking about other ways to allocate. You could probably find a global large cap fund that just takes all the largest countries, all the largest companies in the world and puts them into one portfolio. That could certainly be possible. All the studies on large cap, mid cap, and small cap, they're just as effective in Europe as they are in the United States. That distinction works. So it does make sense to break up European stocks between large, mid, and small cap. But it doesn't make sense to do US large cap with European large cap all in one category. That's the question you'd have to study. So this isn't what's current, but it's what people are talking about. Some books in this area. Jim Rogers, you can find him out there on YouTube. He's a great person to listen to because he's so wealthy, he doesn't care what you think. So he speaks his mind, and he's a very provocative speaker. His book, Street Smarts, I thought was a pretty decent book. He moved his family to China. He wanted his two daughters to be fluent in English and Mandarin, and moved them to China. He couldn't take the pollution of Beijing, so they moved to Singapore. And his daughters are still bilingual. He's convinced Asia's the future. That's where all the growth is going to be, China, India. And so that's what he bets on. So that's what his book talks about. And then he put his money where his mouth is and moved his family there and made sure his daughters would be familiar with that region. Several years ago, people were saying Africa is the future. That's where all the growth is. And that comes back to those birth rates. That's where the young people are. Remember, young people are the best at producing more productivity. They're more productive. Change of productivity is much higher. So if you have a younger employment base, you're going to have more productivity. You're going to grow faster. Africa has a lot of challenges, though, obviously politically and otherwise has been hampering it. I think infrastructure is probably the biggest one. You're seeing big battles in Ethiopia and Somalia, just Ethiopia trying to get to the coast, and all these battles. I mean, there's civil wars everywhere. It makes it really, really tough. But that has been. The Economist had a whole series on Africa being the future, Africa being the future. We'll see if that does happen. Africa does have a lot of kind of natural resources that are really, really valuable, that they could tap into that. But then you read this book. I do recommend this book. It's a long book. These guys just won the Nobel Prize for writing this book, so I wasn't the only one impressed by it. The Nobel Prize committee thought it was pretty good. What they're asking is, why do some nations fail and why are some successful? Why was Argentina one of the richest countries in the world 100 years ago, and now it's coming back, but became a disaster? And they go through all the particular questions, and the final answer they come up to is the political system. How is the political system rewarded? If it's rewarded for taking care of themselves, the country fails. If it's rewarded by taking care of the people, seems pretty simple. But he asks, what about landlocked countries versus countries on the coast? What about countries with a lot of natural resources and countries without natural resources? What about countries with these cultures versus these cultures? They went through all of them, and they said a lot of those don't make a difference. And the really big thing is, what is the incentive for the people running the country? And if they're ripping people off and paying themselves, that's what makes a nation fail. It's really, really good. It's a long book because they go through so many examples to prove their point. So I do recommend. And if you ever go to the great courses, their courses I think are a little expensive, but they're pretty good. They're like online college courses. This guy, top one called Foundations. A student of mine sent me this and he said, well, it's really good. I really liked it. So I watched it and it was essentially a summary of this book. So it's like, I'm here, I've heard all of this stuff before. So he essentially took that book and made it a college class. So you can read a really, really long book, or you can watch a shorter series of videos covering the same thing. You as an investor, if you're trying to figure out where in the world you want to invest, that's the key you got to look for. What are the characteristics of those nations that are going to turn things around and get back on their feet and do well? And this guy, Sharma, he has a book out. It's getting a little dated now, but interesting book. He's at Morgan Stanley. He talks about the 4Ds, and boy, he called this just right. This is 7 years old, 8 years, 9 years old. He talks about the 4Ds. The 4Ds are depopulation. We just talked about that. People aren't having babies, population getting smaller. Deglobalization. You're seeing now this battle between US and China. And it's interesting in his book, he says with deglobalization, the country that's going to be the hardest hit is going to be Germany. And what do we see today? Germany is just not getting it together. It's been a disaster. But he said deglobalization is going to, US will probably do all right with deglobalization, and Germany's going to be crushed. And so far, he got that right. Deleveraging, governments are so heavily overwhelmed with debt. The US, Japan, and really the entire world. How is that going to handle things? And then de-democratization. You're seeing, especially in Latin America, you take surveys now, people are saying, I'd rather have an autocrat, unelected autocrat that just makes decisions without elections. That's how negative they become on democracy. That's pretty scary. But that's what in his book. It's an interesting book. He takes each one of them and talks about what it means as an investor. What is that going to mean to growth, to investment, to company performance? So those are the kind of things, if you're going to be a world global investor, you need to read these kind of books. But he does have a book out there. I just can't remember the name of it. And there's Jim Rogers himself right there. I forget how many pages this thing is. It goes on quite a while. If you go into Bloomberg, there's something called WEI, which is all the world stock indices. But I just discovered here recently, if you type IN, it brings up every index Bloomberg has. It's really an incredible site. So just type IN. You have fixed income, real estate, stock markets, every market. It's pretty amazing. Was not aware of that before, but WEI is not a bad one to do. You can click on like the Americas and it brings up all of the Americas. So it has all of these. You can change the time period you're looking at. You can do it in dollars. You can do it whatever currency you want to, and just see what's going on around the world. You can do year to date, last 12 months, last 10 years, whatever. It gives you all the different markets. Argentina has been the strongest performing market here recently. New president, really interesting what he's doing. How long will that last? Be interesting. Argentina has been really good at disappointing every time they start doing well, but maybe this is the time they'll work it out. But yeah, there's a lot of markets around the world. Every one of them has their own distinctive characteristics. You have to be careful in some of these markets because there's like maybe only 2 or 3 companies that dominate the entire market. So when you buy that countries, you're really just buying those 2 or 3 stocks. So you have to watch out for that. But yeah, there's a lot of resources on Bloomberg. All right, that's it for stocks and bonds. So DC Cuts I and Bucks gives you a really good template to talk through these. So our last asset class is alternatives. So why do people do these other asset classes? Really 2 reasons. Make sure you get both of these in your intro to alternatives. One is diversification. Alternatives tend to be are lowly correlated with stocks and bonds. So they give you diversification. And for real assets, and we'll start with real assets tend to give you protection from inflation. And that was certainly true in 2022 when you saw oil prices and house prices jumping up and food prices. So diversification, protection from inflation. So let's talk real assets. So I'm not going to do all the alternatives that are out there. Well, I'll mention a few other ones out there, but real assets, these are things you can hold, you can touch. Unlike stocks and bonds where you just have a piece of paper that give you ownership rights or investment rights, real estate, you actually have something you can touch. So we'll start with the first one, real estate. I don't know if there's any real estate majors in here, but real estate has an expected return. We're not really sure, but somewhere probably between stocks and bonds. If stocks are going to make 8%, bonds are going to make 4%, real estate's in that 5 to 6% range. We think people say they have low correlation to stocks and bonds, but we really don't know because real estate doesn't trade every day. We don't know the price of real estate every day. So we use what's called appraisals. And so appraisals, yeah, you sit down usually once a quarter. In commercial real estate, they'll do an appraisal and they'll say, this is what we think our buildings are worth. They'll put that down into an index and you'll get a return. But there's something called appraisal smoothing. Appraisals aren't going to be as volatile as stocks and bond markets where they're just moving all over the place. So real estate looks low risk, looks low correlation, maybe because we don't have true prices. They don't trade every single day. We don't really know how they're moving. And so we're not really sure. When I was at USA, they started a new department. They moved me into it, and we did a lot of work on real estate because USA had a large real estate portfolio. And we had to figure out how do we fit real estate in there. And we did a lot of studies to try to figure out where it goes. And we finally just said somewhere between stocks and bonds. Does have some diversification benefits, but not nearly as strong as you would think based on the numbers we have. It is a very illiquid asset. And we'll talk about what happens when you try to make it liquid. You can break it up between commercial real estate and residential. I don't delve into residential as an investment. Some of y'all might do it. You might be on the residential side. I think everybody's doing that now. Amazing how many of my friends just suddenly started becoming real estate brokers. But a very different market. You're now seeing BlackRock and some of these other large investors buying residential real estate. So that world is starting to change some. But let's focus in on commercial real estate. Equity real estate is usually broken down either geographically or by property type. So property type, you can have hotels, office, retail, industrial, apartment, malls, and there's a few others like storage. So property type and geography in the US, Southwest, South, Northeast, Midwest, West. And you probably want to try to get diversified by both geography and property type. Right now, office and retail, office especially, because work from home is getting really crushed. Although I think New York's doing okay. Retail got crushed by COVID, but retail has been a little bit of a challenge. Industrial has been the place to be because all these AI firms need these industrial plants for their data centers and those kind of things. So, what about malls? Anyone in here never been in a mall before in your life? My generation grew up in malls. That's where we went to get away from our parents, but you guys never go to malls. You have your iPhone with you or whatever. That disaster. There's a mall right next to where I grew up. I visited a few years ago. I mean, it's empty. It's massive, and they have some local community schools meeting in there, which is taking up maybe 5% of the space. Just empty, dead real estate sitting there. Apartments has been a decent place, especially with a strong housing market. Hotels has actually done pretty well, but the property tax is pretty important. They're all very different as far as how they're impacted by the economy and by interest rates. So you get some diversification there. NCREIF is a good place to go. They used to provide their data for free. Now they don't. So you used to be able to get quarterly real estate returns from NCREIF, and you could use it in your analysis. We did when I was at USA, but now they require you to pay them money. But you could get the quarterly data and look at it. It's tough to get real estate numbers. Now, if you're real estate major, you definitely want to work in this area. But if you're not real estate major, you can still go into the real estate field if that's what offers you a job. I know a lot of people doing real estate now that started off just general finance. So it is a field. Um, but what if we take real estate and we try to make it a liquid asset? So there's something that was created mainly by the tax code called a real estate investment trust. It's essentially a firm that does nothing but real estate, but does it as a publicly traded stock. So it's like putting real estate into a stock ticker. And is that a way to get real estate and get all the diversification benefit, but get all the liquidity so you don't have to worry about illiquidity? And the problem with that is as soon as you take something that's illiquid, make it liquid, it starts looking like a completely different animal. So REITs don't look like real estate, they look like small cap stocks. All their characteristics, all of their risk, all their correlations look like small cap stocks. So when you make something that's not liquid, you make it liquid, it really changes the nature of it. You can look at REIT.com. I don't know why I have that default thing at the end, but REIT.com is the biggest player out there. Their site has a lot of free stuff because what they're trying to do is get people to invest in REITs. So they're like promoting REITs. They're a kind of a trade association. And so what is a REIT? Investing in REITs. They're pushing REITs as an asset class that's special and gives you access to real estate. I don't view REITs as real estate. To me, it's small cap stocks. They're very volatile. A mutual fund I ran at USAA before I ran it. Fortunately, they fixed it before I got it, but they had 25% in bonds, 25% in stocks, 25% in gold, which was crazy, and 25% in REITs. And the argument is make it really diversified. That was a horrible fund. Gold is so volatile that you would never put more than 10% in gold. They had 25% in gold. And then they put 25% in REITs thinking they get real estate diversification, and they ended up having just this heavy allocation to small cap stocks. That fund just about blew up, and then I inherited it. But by the time I got it, it was 70% stocks, 30% bonds. All the rest of that was taken out. We had a little bit of gold in there. So you really can't make the argument for REITs being real estate. NAREIT has tried to do that, but the data just doesn't support it at all. So I mean, you can try. I wouldn't recommend putting a massive amount into REITs. Putting a max amount of REITs is like putting all your money in one sector or one industry. It's not a good investment play. Now, if real estate's a good protection from inflation, it should have done well in 2022. But REITs didn't do well in 2022. So why didn't REITs do well? Well, one thing you got to be real careful with REITs is they have high dividend yields. They have high dividend yields because the tax law requires them to pay out their earnings as dividends. And if they do that, they're tax-free. The REIT itself is tax-free. When they pay out the dividends, whoever gets the dividends has to pay tax. So they're high dividend paying stocks. When you have a high dividend paying stocks, a lot of people buy them as a bond substitute, which means they have a lot of duration, which means what? When interest rates rise, REITs really struggle. And what did interest rates do in 2022? They rose. So REITs can look a lot more like bonds than they look like real estate or even stocks at times. When interest rates rise, REITs will sell off. Same thing with utility stocks. Utility stocks have high dividend yields. When interest rates rise, they tend to fall because people view them as a bond substitute. So you really have to be careful. 2022, you got inflation, real estate prices are going up, and yet REITs are crashing. Why? Because interest rates are rising. And that's putting a lot of pressure. And REITs are heavily, heavily levered, a lot of debt. So when interest rates rise, their cost of debt goes up. So there's a lot of problems with that. So be careful. There are private REITs. USA has a few private REITs that aren't publicly traded. That really is real estate. It's just a way to get REITs without having to buy individual properties. You kind of like putting REITs into a mutual fund, but the mutual fund's not traded. So that protects you from that daily price gyration. I want to talk residential real estate. I'm not real sure what BlackRock and some of these other firms are doing. They look like they're buying up entire city blocks. Exactly what their goal is, I don't know. It's really unique, really unusual. But who knows what they're doing. Then you have Airbnb, right? I've seen more. We're riding a bike in Helotes. One guy moved and his house is not Airbnb. Sometimes the homeowners associations don't allow that. He must have got away with it somehow. It's a nice house, so I guess he's got to try to make some money that way. But the residential side, little tricky. All right, so that's real estate. The second real asset to cover is one of my favorites. It's timber. I don't know if you thought of timber as a separate asset class. What I love about timber is, first of all, it's really two asset classes in one. It's both a commodity and real estate. So real estate, they grow trees either for paper or for construction. They do give you really, really good diversification because they tend to be local markets because lumber is so heavy to lift and transport. I don't know, no one in here, you went to Costa Rica, but not on the last trip, but our last Costa Rican trip, they have tree farms up there coming down out of the mountains, and our team was coming in. One of those trucks with those massive logs completely flipped over in the mud and was blocking the entire road. I don't know how they bring, I mean, those roads are not the best roads at all. They had a lot of rain and it just came over. So it's hard to export trees. They're really heavy. They take up a lot of space. So it tends to be a local market. Did y'all know that Texas is a major tree producer? You go up north, they think Texas is all desert, right? Tumbleweeds everywhere, but East Texas is a major producer of timber. So yeah, Texas is a big part of this, not just Canada or the Northeast and Northwest. The returns tend to be good, exit diversification. And one thing that's really wonderful about timber is if you don't like timber prices, you can just let the tree sit there. And what happens to the tree while it's sitting there? It gets bigger. So that's kind of nice. You can't get that with oil. If you don't like oil prices, you can let the barrel of oil sit in your garage, but you're not going to have more oil. Oil prices might come back up, but the oil is not going to grow. But with timber, if you don't like it, they call it store it on the stump. Just wait till prices come back. The other thing you can do is if you don't like timber, you can sell the real estate because you own land. So if you don't like timber, you can sell portions of the real estate or lease out some of the real estate. There's a lot of things you can do. One of the best firms out there, HTRG. See if I can find that. And what color do you think dominates their website? Do you think it's the brown after they've taken all the trees down, or do you think it's green? What color would you use if they're their web designer? So pretty. Look at that. They're gonna rip all these out of the ground soon, but it's so pretty. So this is Timberland. It used to be Jackson. There's a few firms that have merged. They make the point that they're good for the environment because they do replant a lot of trees and they're very good at refurbishing and all that. But they are ripping the trees out. And I don't know if you see how they get trees out of the ground now. There's no more lumberjacks sawing. It's one big machine just rips the thing right out of the ground by its roots. It's pretty amazing. So here's their argument for timber. Timber is a pretty popular investment for large investors because you tend to have a lot of money. We'll talk about commingled funds versus separate accounts. Obviously, they're going to talk a lot about global warming and those kind of things on their website. They're going to have a very ESG type of focus. It's a big market. You may not hear much about it. If you like the outdoors, boy, I tell you, this could be your entire career. So get your finance degree, go to Texas A&M, get a forestry degree. You'll be wealthy and outside the rest of your life. I mean, it's like really nice career. We talked to a guy from Timberland. And he was in a suit, and he's like, "Yeah, I wear a suit like 3 days a year. I just when I visit client, I'm outside in blue jeans most of the time." But yeah, finance plus forestry, and that's a place where you're set. You better like it because you're not going to do anything else with those 2 degrees. But if you get finance and forestry, this could be an incredibly high-paying career. It's not going anywhere. It's going to be around for quite some time. Pretty lucrative career. And this could be a firm you could apply for. They probably have some hiring going on. They're all wearing suits here, but they probably don't wear suits all that often. So I like it as an asset class, and as a career, it would be pretty interesting. I don't think UTSA has a forestry degree, but maybe they do. But I'm pretty sure A&M would. Or now we get to commodities. So we did real estate, timber, and now commodities. So commodities have all different types of correlations to other asset classes. So they're kind of all over the place. But the main ones we think about are energy, agriculture, and metals. And FinViz does a really good job of showing these. You just click on futures. So you have the stocks. I think we looked at this before. You have the stocks up here. Then you have energy, West Texas, Brent. See how far apart they are? They're usually pretty close together, but the last few years, because of storage issues, their prices have somewhat distanced. So West Texas, Brent, gasoline, heating oil. Heating oil and oil used to be highly related. And then natural gas especially got really cheap. Natural gas has come up quite a bit because of the Ukraine war. Natural gas got down like $2 or even lower. So these used to be correlated to each other. Well, gasoline and oil is still correlated to each other, but natural gas and oil have somewhat distanced themselves because of fracking, what's going on with just the discovery of natural gas. Ethanol is, I guess really agriculture. You have your bonds over here. Then you have your your food products, cocoa, cotton, and textiles, orange juice, coffee, lumber, sugar. Then you have your metals, gold, silver, platinum, copper, palladium. More on the food side, cattle, soybeans, corn, wheat, rice, oats, canola. Then you have your currencies down at the bottom. So they do a pretty good job. Each one, as you look at, like if you look at natural gas, go back monthly, you can see how low natural gas got. I mean, even below $2. Then you have the Ukraine war. And we had lucky after the Ukraine war, they had a pretty mild winter. So that kind of brought the prices back down. Natural gas is very sensitive to temperatures because that's how we heat our houses with natural gas. So it's very sensitive to temperatures. If you were to graph natural gas versus gas oil, you'll see the relationship really started breaking down a few years ago. It used to be much tighter relationship, but it's really unwound. So natural gas has gotten really cheap and has stayed down there quite a while here the last few months, and even the last several years. If you look at the majority of the time, last few years, it's been right around that $2 to $2.50 range after being up to like $16, $14 just back in 2008. So it wasn't that long ago. But yeah, FinViz has some really good charts. Gold is hitting new records, right? Hit a new record last week. I don't know where it is today, how close it is today. So what makes gold go up? Inflation, weak dollar, low interest rates, which all related to each other, right? So high inflation gives you a weak dollar. But yeah, so gold, anytime you see a weak dollar, gold is going to do really well. That's the reason gold did not do well in 2022. Remember 2022, all that inflation, gold didn't help you. Why? Because the dollar strengthened. So gold isn't just inflation; it's also currency based. But gold right now is just killing it. I don't know how many of y'all have gold going on. There are gold ETFs out there. You got to be really careful with them. They can be quite dangerous because they don't actually buy gold. They buy gold derivatives that are very liquid, have some credit issues. So you got to be really careful. So you can invest in commodities, but you have to be real careful. You're going to do an exchange traded fund. We'll talk about those in a little bit. Some kind of fund of funds. You got to be careful which one you pick. The two biggest ones out there are GSCI and AIG. The GSCI is overwhelmingly energy. It's about 60% energy. Whereas the AIG is only 30% energy. So if you buy the GSCI, you're really betting on oil prices more than anything else. I think I would prefer the AIG one just for diversification benefits. Although oil has been a really good protector from inflation, even better than gold here recently. So if you're really worried about inflation, this one might not be too bad, but the allocation can be very different between different funds. So make sure if you're looking at an exchange traded fund or a mutual fund that does commodities, get the allocation between energy, food, and metals, and make sure you're comfortable with that because if you get the wrong one, you could be really shocked what returns you could get. Commodities can be a really important part of a portfolio. Most people, the guy who did USA's gold fund, he worked for me, and you would think he would have been pushing gold, but he actually said, don't go over 10% on gold. It's just too volatile. It's too dangerous. So yeah, gold. I mean, obviously you would have loved to have gold here recently, or even Bitcoin, those kind of things that have recently shot up, but that doesn't mean you should have 40% of your portfolio in them just because they've done well recently. One class we're not going to talk about much is specialty markets, collectibles. I try to find a recent article, and they're just you don't get much on these. So this is an old article, but at least lists what type of specialty are. So a lot of art, work, fine art, wines, stamps, coins. One of the students from this class was a coin collector. Cars, rugs and carpets, musical instruments, jewelry, special type of properties. And here's the index itself. They say it's up 90%, but that's over, I don't know, 10 years, 15 years. I don't even know where this was actually done, but it gives you the categories, and there's more categories than this. There's a guy in Costa Rica. His specialty is beetles. So he goes out into the jungle, finds two beetles, introduces them. They have a baby beetle, and he's now created a beetle that's never existed before in the history of the world, and he'll sell it for $500. So I mean, people will buy anything if it's rare, unusual. So I'm not an expert in this. You could make this your career, right? Go to Sotheby's or some of these major art houses and become an expert. You could make that your career. So yeah, the student I had who does coins, I mean, he could make that his career. I think it's more of a hobby for him, but he does collect coins. So anyway, you can put that on the exam, but you can kind of leave it out. The next thing I put under alternatives, for some, this is not an alternative, it's a separate asset class, but it's private equity. I say venture capital, I should have said private equity. Venture capital is a part of private equity, but it's investing in firms, but not in the public market, doing it as a private investor. Venture capital is when you do it to create a brand new firm. So with venture capital and private equity can be huge firms. So right now, today we saw an article where they're talking about taking Walgreens private. Walgreens is a big firm, struggling really hard. Take it private, fix it, and have it go public again. Dell Computer was a public firm, went private, went public again. Burger King, public firm, went private, they fixed it, I guess, and then it went public again. So it doesn't have to just be startup firms, it can be bigger firms. So think of private equity as the bigger category, but related to venture capital, it's a way to get into small, brand new firms without having to be in the stock market. You don't see those daily fluctuations. They're non-public companies. You are an equity investor. So the way it worked at UTSA is we would allocate an amount of money. We never did much. So I think like $300 million or something, just really small for a firm with $100 billion in assets. It was never more than, a small fraction. But we say, okay, we're going to do 300 million. So I have to go out there and find the partners that we're going to deal with. Some general partner. We say we're interested in venture capital, And they say, okay, we'll take 50 million, and then we don't give them 50 million. We commit to 50 million, and over 2 to 3 years, they'll have cash calls. They'll say, hey, send us 10 million, send us 5 million. They'll invest it, takes them back 3 years to invest. And then after 3 years, then they start sending us quarterly reports. We don't know how much these firms are worth. There's no public market. We can only kind of estimate what they're worth. We can see if they're making money or losing money. After about 5 or 6 years, they'll start taking these firms to the public market, do an IPO, an initial public offering. At the end of 10 years, the contract usually ends. You hope that all the firms are going public by then. Sometimes there's a few stragglers. We had some where there's something there, but it hasn't gone public yet. And you're just kind of waiting for the thing to either die or do something. But generally 10 years, everything's gone public. My job at USA when I inherited this portfolio was to figure out what to do when the firm went public. Did we sell the stock? Did we keep it? And so my job was, and I usually sold them like 2 weeks after they went public. We had some big firms in our private equity portfolio. We call that the J curve. So there's 2 or 3 years where you're just sending them cash, and the firms are losing money, nothing's going on, and then suddenly things turn, and suddenly you have these really great companies making a lot of money. You get your money at the end, but it can be a 10-year cycle. Firms like Harvard or schools like Harvard and Yale, they do a lot of private equity. That's a big part of their investment portfolio. You usually have to have quite a bit of money to do private equity. Generally, the entry points are $50 million, $100 million. You have to be able to put quite a bit of money down. This could be your career as well. So what's the private equity city of Texas? Y'all think? Yeah, Austin is the tech. We have a couple of students in Austin doing private equity right now. John, who was in this class, he's doing quite well. I should call him up and see how he's doing. But he's been really bold. I've been pretty impressed with the way he's moving around. But yeah, he had to go up to Austin. You've got the Delionaires there. You've got a lot of other. You have the university, which they draw a lot on UT Austin. You do tend to see private equity in certain cities drawing on certain universities, like Boston with MIT and Harvard, or the Silicon Valley, that they tend to pull on certain students from certain cities. But there are UTSA students in this market doing quite well. If you're going to do private equity, you're almost going to have to go to one of those schools and get your master's there, because these are small firms. They're not going to go around the country looking for people. They tend to have relationships with the university. So if you got your master's from Red McCombs, you could probably get a job with one of these private equity firms. They don't hire many, so you got to hit them just right, develop a relationship, but we do have some contacts there. I don't think it's as high pressure of a job as you might think. You think of investment banking, yeah, that's the 60, 70 hours, a lot of pressure, a lot of stress. Private equity, the stress comes in points, but it's not just constant. I think it's a little more relaxed job than you might think. They can be pretty good jobs. It can be a really great career. It could be one of those careers where you do it for 10 years, you make relationships, and then you become the CFO of one of the IPO firms that you help develop, and you actually go in and become an entrepreneur yourself. So that's venture capital. What else could be alternatives? Some people think hedge funds are alternatives. I don't consider an alternative, but I consider them an alpha play, a way to beat the market. So they're not really asset classes. They're buying stocks, they're buying bonds, they're buying commodities, they're buying all the stuff we talked about, but they're generally doing it going long and short, using derivatives. They're doing it in ways that make them really unique. They're trying to beat the market. So I don't consider that type an alternative. I don't consider derivatives, options, and futures. We'll talk about them later. I don't consider them an alternative. I just consider them another way of getting into those other markets. You can use futures and options to get into the stock market, but I'm going to consider some people do consider currencies to be an asset class, and that's certainly possible if you want to research that. The way you look at that, it's called currency overlay. Let's see, overlay. So a currency overlay portfolio essentially what someone's saying is, hey, we have this international stock portfolio. We're 20% Japan, we're 30% Europe. But we don't, if we're 20% Japan, now we're 20% the yen. We like Japanese stocks, but we don't know if we like the yen, but we don't have anybody qualified to tell if it's the yen's going up or down. So they hire a currency overlay manager. And what the currency overlay manager does is look at their stock portfolio and say, well, you got 20% in Japan, but we don't like the yen. So we're going to cut your yen allocation from 20 to 10, and we're going to put you in the euro. And they just manage a currency portfolio over the top of that. Currencies could be an asset class. It's a zero-sum game. So if a currency wins, that means another one's losing. It's not like stocks where everything can go up. So it's a zero-sum game. If you're interested in currencies, then you need to go get a PhD in economics, because that's what currency investors are. They're economists. We won't talk hedge funds in here. I would, if you can go interview with a pension plan or some investment house, I would go out and just Google what are the primary hedge fund strategies out there. Just make sure you know what they are. I gave you 3 here. Long short equity. That's just another way to buy stocks, but you do get to short some stocks, so you can kind of reduce your risk a little bit. Market neutral really is a pure alpha play. If you're long one stock, you're short another one in the same industry. So you might be long CVS and short Walgreens. You might be long Apple and short Oracle or something like that. So you're long and short, and your goal is to have a beta of 0. That is, you're uncorrelated to the market. The market could crash 30%, and you could still be making money because the stocks you were short on went down more than the stocks you're long on. And in global macro, we use a lot of global macro at USAA, and that's just, they invest anywhere in the world, but they don't buy individual stocks. They buy entire markets. They do a lot. They might buy the Canadian market or the European market, and they do stocks, bonds, currencies, commodities. So they're just looking at where can they make, what's cheap, what's expensive. But there's several others. There's the stress debt. There's convertible bond arbitrage. There's several other merger M&A arbitrage. There's several other strategies out there, but they're not a separate asset class. They're a way to try to beat the market or get access to an asset class in a more efficient way. Could you work for a hedge fund? If you want to work for a hedge fund, you're probably going to get a PhD in math, because that's what they're hiring. The hedge funds I've worked with, these are a bunch of mathematicians. They weren't finance people. So you'd have to get, what was James Simon? He was a math teacher, right? Most successful investor of all time, not a finance person, a math person. It wouldn't hurt you to get a PhD in math, even if you didn't want to work for a hedge fund. All right, so next class, we're going to start working on an exam 1, question 2. So get ready for that. We're going to be doing that all of next week, and then we'll have a team question on it as well. All right, everybody's good with everything? Your exam 1, question 1 is good. So there's question 1. You want to say in your own words, well organized. So we'll start there next class. So